The first stock that we will talk about today is Mankind Pharma, and I like to call this one the acquisition machine. Historically, Mankind Pharma was just a pregnancy kit company with Prega News and Manforce as their flagship products. However, since the 13,630 crore acquisition of Bharat Serums and Vaccines in late 2024, they have transformed into a high-barrier biotech player through something called biosimilars. Now, what are biosimilars? They are large, complex molecules that are grown in living cells, and they make for some of the world's most expensive drugs. Biosimilars are the generic versions of each of those drugs, but it's all the same game. Unlike simple pills, you can't just copy a biologic. You need massive R&D, sterile manufacturing, and clinical trials. This keeps competition very low. The $1.65 billion acquisition of BSV is arguably the most critical move mankind has ever made. BSV is a global leader in vitro fertilization biologics. They developed India's first recombinant FSH or follicle stimulating hormone, which is a hormone used in fertility treatments. BSV also holds patents for recombinant anti-D or treating rhesus disease in pregnancy. In fact, this is a global first that Mankind is now scaling in 20 plus countries. Mankind also inherited a team of 60 plus specialty scientists and world-class manufacturing plants in Ambernath and Germany. At currently discounted prices of some 30% from the top, at least one tranche of an investment seems warranted. Second is Poshmark, which I call the regulatory fortress. Poshmark is the ultimate coffee can stock. They work with phosgene gas, which is so lethal that the government rarely issues new licenses. This is basically a monopoly by regulation. They're essentially a toll booth for other chemical companies. If a company needs phosgene-based intermediates, they have to go through Poshmark or Atul Limited. Their debt to equity is 0.0. They fund all expansions through internal accruals. The biggest shift in 2025 though has been Poshmark's entry into API manufacturing. Previously, they only made the intermediates, which are the ingredients for the ingredients. By making the final API themselves, they capture 3x to 5x more value per kilogram of phosgene compared to selling basic intermediates. Poshmark has invested heavily in a new multi-purpose plant at their Panilav site to manufacture actual drug molecules. Their 25-26 pipeline includes high-demand APIs like azithromycin, tenofovir, and glimepiride. The stock's PE is expensive, but it has corrected to about one-third of its all-time high, worth a small bet I presume even with a low-risk profile. The third is Page Industries, which I also call the efficiency king. The stock is also part of my ideal portfolio, and I believe it absolutely has to be a part of anyone's portfolio. For the rest of my portfolio, watch this video. Page Industries or Jockey is a masterclass in working capital management. They have an asset-light model, which is surprising when you look at the massive scale that they operate at. Their moat isn't just the Jockey brand, it's their distribution reach. They're in 120,000 retail outlets. A new competitor would take at least a decade to build just that. Their return on capital employed consistently hovers around 40 to 50%, which is legendary in the textile and apparel world. Now, they're going into a new round of growth from Jockey Juniors and Athleisure. Athleisure is now their fastest growing segment. With the work from anywhere and fitness trends becoming permanent in urban India, Page has expanded its range to include premium gymwear, hoodies, and joggers. They're also leveraging the trust that parents have in their brand to capture the premium kids innerwear and loungewear market, which is currently highly inorganized. I would buy this stock at any price for the long term, but with 30% down from the top after a 3-year correction, this is basically a no-brainer. Fourth is Dhanuka Agri-Tech, which I call the asset-light Agri play. Unlike UPL or PI Industries, Dhanuka doesn't spend billions on manufacturing raw technicals. They focus on formulations and marketing. They partner with global Japanese giants like Nissan Chemical to bring innovative molecules to Indian farmers. They're like the Netflix of Agri. They don't own the studio, they just distribute the best content. They also have a very high dividend payout ratio, so it's a cash cow for investors. For 2026, the Dhanuka Digital Initiative, which is using drones and AI for precision farming, is their growth engine to counter the volatility of monsoons. I have talked about stocks like this in a video focused on AI. Please watch here. Finally, we have Everest Industries. Everest Industries is currently a turnaround play in the building materials sector. The company reported a consolidated net loss of 18 crores, a sharp decline from previous quarters. Because of the losses, the PE ratio is currently negative, making it a risky grade on many fundamental filters. However, Everest is sitting on significant non-core assets. In late 2025, the company received environmental clearance to sell 23 acres of land in Tamil Nadu for approximately 133 crores. This cash influx is expected to be used to pay down high-interest debt and fund their new high-margin plants without further borrowing. Everest is currently the third or fourth largest player in the Indian PEB market, which is pre-engineered buildings market, and it holds about an 11% market share. For Everest Industries, the PEB segment is the redemption story. The legacy business was dying, but by positioning themselves as a high-tech steel engineer for India's logistics and infrastructure boom, they are successfully rebranding.